This chart plots a highly volatile market price against a stable intrinsic value to show how sound investing actually works. It directly rejects the bigger fool theory, the idea that you can buy an overpriced asset just because someone else will pay more for it tomorrow. Mastering valuation means estimating a firm's true baseline based on its cash flows and risk, and then actively acquiring assets when the market price dips below that intrinsic value. This diagram breaks down the three distinct categories that every valuation method falls into. Discounted cash flow relies on fundamentals, measuring the present value of expected future cash flows. Relative valuation takes a different route, determining an asset's worth by analyzing how comparable assets are currently priced in the market. Contingent claim valuation applies option pricing models to assets that possess inherent flexibility, like the option to delay, expand, or abandon an investment. Choosing between these three isn't a matter of preference. If you select the wrong category for a specific asset, your entire valuation will be inaccurate before you calculate a single number. Even when you choose the right approach, technical errors easily corrupt the results. Within DCF models, the most common point of failure is crossing the mathematical line between equity and the firm. This flowchart illustrates the strict mechanics of that division. To value just the equity, you isolate the residual cash flows remaining after all debts and reinvestments are met, and you discount them exclusively by the cost of equity. Conversely, to value the entire firm, you calculate the cash flows generated prior to any debt payments. Because you are factoring in all claim holders, you must discount those flows using the weighted average cost of capital. Mismatching these components, discounting equity cash flows at the firm's cost of capital, or vice versa, creates a mathematically biased estimate that will artificially inflate or depress the final valuation. This matrix maps out how standard DCF models break down when applied to businesses with irregular structures. For startups with negative earnings, the analysis must shift entirely to estimating future growth potential. Meanwhile, financial services require dividend discount models because regulatory constraints make defining debt and reinvestment highly unreliable. For heavily distressed companies, standard cash flow models fail completely, so equity must be evaluated as a contingent claim, acting as a call option on underlying assets. A technically flawless calculation is useless if the model itself ignores the structural realities of the business being valued. This formula establishes the strict boundaries for mergers and acquisitions. The status quo valuation of a target company, assuming existing policies remain unchanged, provides the baseline. Any premium paid above that baseline must be covered by calculated synergy value. Managers apply a similar discipline internally using economic value added, tracking whether individual projects generate an actual dollar surplus over their capital costs. Applying these frameworks prevents executives from destroying capital through undisciplined expansion or overpaying for acquisitions. Valuation will always contain bias, and forecasting the future guarantees estimation errors. But the discipline of the process forces you to structure that uncertainty. The actual number you calculate is secondary. The true purpose of the process is mapping the core financial drivers of a business, giving you a reliable mechanism to identify and exploit market